Alright guys, so let's talk about cause and effect today. The US trade war is starting to backfire in just so many ways. Countries are standing firm and as a result, a supply crisis is coming for the US. Now the main event of course is the struggle between Washington and Beijing, and neither side wants to give way. China is tired of the US trying to corner its economy, and for the US, the main agenda is crystal clear. US manufacturing has to come back. Besson calls it a rebalancing, and it will have to be done at China's expense.
What we will first want to see is a de-escalation. We will likely revisit the purchase agreements that were put together in the first China trade agreement in January of 2020 to make sure that the Chinese are honoring those agreements. Everyone knows that China needs to rebalance towards more consumption. So if we could rebalance together, then that would be the big deal. But in the meantime, we're going to bring down the unfair trade barriers and hold them to the agreements that they previously signed.
Now, Besson has two big demands for Beijing. The first is for China to remove their tariffs, which he calls a de-escalation, which to be frank is quite hilarious. Now, the second is for China to buy an additional $200 billion worth of US goods in 24 months. But I highly doubt he will get either of them. But for China, the way forward is quite clear. Apart from tariffs, you want to put more pressure on the US financial system. After all, it was the bond market imploding that forced Trump to do a tariff pause. Now, even Japan is using their holdings of US debt to remind Besson of the leverage they hold. $1 trillion in treasury bonds isn't something to sneeze at, especially when the US, they are very desperate for rates to come down. Japan dumping their pile of US debt would spike yields higher. Traditional US allies are realizing that the trade war is an existential battle for survival as well, so nothing's off the table in this struggle. And for China, this decoupling has to go much further than just trade. They still have over $700 billion worth of treasuries, which is a huge amount to hold. Besides just the risk of sanctions, the value of China's dollar holdings are getting clobbered. This is the biggest dollar dump since 2022 and more losses might be coming ahead. We are witnessing an exodus of domestic and foreign real money away from the US. For China, this is a double whammy. Now the value of your bonds has dropped by 9 to 10% if you decide to convert them back to the Chinese RMB. It easily wipes away any yield you would have gained over the years. And this will only strengthen the resolve of China to de-dollarize. It doesn't make sense to hold on to a losing position while finding your own containment. While China's deleveraging their treasuries is going to be a very slow process. Now dumping all at once could signal financial war. It could just drive Trump crazy. Beijing is most likely going to just let their positions mature without reinvesting back into treasury bonds. But beyond just government bonds, China's holdings of other US debt is now at risk. The Trump administration is about to privatize Fannie Mae and Freddie Mac. Now these are big mortgage giants and a ton of their bonds are held by the Chinese government. Beijing bought these instruments because they yielded more than US treasuries and there was an implicit government guarantee. But that might be going away, especially if the companies become private, which means the bonds can default without any rescue if Fannie Mae and Freddie Mac decides not to pay. Now Beijing is taking their de-dollarization push more seriously, and they are beginning to do it with their riskiest assets. China's sovereign wealth fund, which manages $1.3 trillion, is starting to cut their exposure in the US private markets. They are selling away $1 billion in private equity investments in the United States, and the amount will likely snowball down the line. Private equity is a high-risk, high-reward kind of investment, but with the Trump trade war, China faces an additional issue. The US is moving to block Beijing from investing into US companies. Now Trump is directing the Committee on Foreign Investment to restrict Chinese investments into the US. And the plan is to ring-fence key industries including energy, agriculture, healthcare, and technology. The justification is of course over national security grounds. That's definitely the prerogative of the US. But let's look at things from China's point of view. Allocating capital into American companies is becoming increasingly impossible. Even if we take away the risk of confiscation, There are three big reasons why China will exit from private US companies. The situation has completely flipped today. Firstly, there's the US recession risk. Now, everyone knows GDP has contracted in Q1. The economy shrank by 0.3% in the first 3 months. And if the US falls into recession, not only will public companies get hammered, private companies could outright fail, returns could collapse, and your equity stake could go to zero. The US government can also force China to sell off their assets on national security grounds. Beijing will have to sell at fire sale prices, and the haircut could easily be 50 cents on the dollar. Finally, Beijing already has a directive to their companies not to invest in the United States. The central government could very well instruct their wealth funds to sell now before the exits are closed. Now, this sell-off could get much worse over time, especially during a Trump presidency. Now, the consequences for the US won't be good. There are many other wealth funds in the world that invest in America, and if the economy continues to sink, they might just follow China's lead. And should funding from global funds dry up, many private US companies will be in big trouble. If private equity funding collapses, these firms will have to head to the bond market at a time where lenders are already walking away from US Treasury bonds. By nature, these are high yield or risky borrowers. They will have to pay at least 4.5% more than what the US Treasury can borrow at. So if Besson issues bonds at 4% yield, private US companies will need to borrow at 8.5% or more. And this just adds more strain to their operations. And in the worst case scenario, they will default on their obligations or they'll simply go bankrupt, they go under. So there are consequences to the trade war. The US system is highly financialized, so China pulling their money out will have material effects. And remember what's coming soon, the tax cut bill. Not only will the 2017 cuts be made permanent, Trump is going to pass a sweeping bill that will add a ton of burden to the national debt.
In the coming weeks and months, we will pass the largest tax cuts in American history, and that will include no tax on tips, no tax on Social Security, no tax on overtime. It's called the One Big Beautiful Bill, and it will be the biggest bill ever passed in our country's history. It will include the biggest tax cuts, regulation cuts, military supremacy, and just about everything else.
The federal government will have to issue a ton of bonds to fund the tax cuts, and this competes with capital for private US companies as well. And the US government will always have a lower cost of borrowing, so rates across the board, they will go up. Now, Trump's tax cuts will add nearly $8 trillion to the deficit over the next 10 years. So expect an additional at least $5 to $700 billion more in bond issuance every single year. The tariffs won't be able to cover this. But this brings us back to China. Where are they going to invest their proceeds? Now, some will be converted to domestic stimulus, while others will be spent on BRI projects. However, Beijing will still need to stash some money in reserve assets. And if we look closely at which markets are deep enough, there's only one avenue that makes the most sense for China. US Treasuries today still make up the biggest safe haven asset market in the world. It's over $28 trillion deep, and because of that, a lot of countries store their wealth in dollar assets. Now, the second biggest haven asset is gold, coming in at $13.4 trillion last December. While it's smaller than the treasury market, it's deep enough for Beijing to invest their reserves in. Now, you combine that with zero counterparty risk, it's quite obvious what China will go for. They will dump their holdings and move more towards gold. Now, at this point, it's one of the safest assets around, especially during a trade war. There are just so many uncertainties that China will likely play defensive. And if we step back and look at China's reserves and their allocations, it further confirms the move towards gold. At the start of 2025, China owned around 2,300 tons of gold. That's the official numbers. It's a lot of bullion, but it accounts for only 6% of China's total reserves, much less than any G7 country, even Russia. So the bid for gold from China isn't going to disappear. They will keep pulling money out of the US and stash even more into gold. China could very easily bump up their gold holdings to 9 or even 10% by the end of the year. Trust in the US is simply gone at this point. But there's another signal in the market we need to talk about. It's another sign that de-dollarization isn't over and where the money is actually flowing to. Apart from money entering gold and euros, capital is flowing into Chinese investments. Now, for the first time in history, Hong Kong spent 46 billion Hong Kong dollars to buy the US currency to defend its currency peg. That's a purchase of $6 billion, the highest in just one single day. Understand what this means. The Hong Kong dollar is pegged to the USD and it's done that way for a reason. China wants to position Hong Kong as a financial hub as well as to maintain affordable exports as well. And if the currency peg breaks, it won't be good for the very purpose of Hong Kong. Now, the Hong Kong dollar has appreciated so much that their central bank had to step in to push it down. The world was selling US dollars and pushed the HKD towards the strongest end of its trading range. Now, the conclusion is quite simple. More money poured into the currency to buy Hong Kong and Chinese stocks. Investors see US equities as risky, and besides just gold, money is flowing into China, and the Hong Kong dollar is just a proxy of that capital flow. It's not a surprise that Chinese stocks won the US by over 20% this year alone. That's the highest margin since 2007. But remember back then, the US and China were still very strong trading partners. There wasn't any trade war like what we are witnessing today. Things have truly gone ballistic over the last 4 months. As a result, we are seeing a grand rotation out of US assets into Chinese assets. But here's the funny thing, this will affect US consumers more than it actually enriches Chinese investors. Now, the right chart shows us the exposure of total household wealth in the US versus China, and focus on the light blue segment that represents stocks. 31% of total wealth is in stocks for the typical American household. However, for China, it's just 10%. So falling stock prices affects US consumers much more. It's the reverse wealth effect. Now, the left chart shows us another reason why money is flowing to Chinese stocks. Bond yields in China are extremely low, so there's very little return to be had, and this makes the dividends of Chinese equities very attractive to global investors. They can now get over 3% across the board, and these are the unintended consequences of Trump's trade war. It's all fun and games until the world decides to move away from what makes the US truly exceptional, and a big part of that is Wall Street. So everything is once again tied to the trade war, and regardless of what we think should happen, Trump is still hell-bent on punishing China's economy. Despite the threat of a recession, we are still being railroaded towards total decoupling.
And I want to know what you think about that. Are you comfortable with the country potentially dipping into a recession for a period of time if you are able to achieve your long-term goals?
Well, you say some people on Wall Street say, well, I tell you something else. Some people on Wall Street say that we're going to have the greatest economy in history. Why don't you talk about them? Because some people on Wall Street say this is the greatest thing that ever happened.
Well, that's what I'm getting at. That's what I'm getting at, though. It's the same question.
Yeah, there are many people on Wall Street say this is going to be the greatest windfall ever happened.
And that's my question,
Remember
the
this.
long term.
Yeah.
Is it okay in the short term to have a recession?
This. Look, everything's okay.
And the longer this drags on, the more damage it will do to US companies. More capital could flow from the west to the east. And if China follows this up with massive amounts of stimulus, it will just draw even more money away from US markets. Bad news for the US consumer who's going to feel even poorer. But let me know what you think. Will China continue pulling away money from US companies? And will more investment dollars leave the US? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.